I mean, people might be interested in both, right? They overlap. And I think a lot of people, like I see on the internet, try and use LLMs to build these models, which who knows? I mean, it's something I would actually try out in the course. But what I want first is, and I sent it in the chat, I'm going to share a screen here. Da-da-da-da. So we're going to be walking through a notebook. It's a 1 hour session, so it's more like a fire hose approach. We're going to cover a lot. Hopefully you retain some of it and it inspires you for the rest of it to go into more detail. And then again, in the actual course over 10 to 12 weeks, we'd actually have time to step into a lot of these concepts one by one. But for today, let's make sure we're all able to follow this. Where's the chat on Zoom? Yeah, so can somebody do me a favor and instead, not in chat, but there's a button for Q&A, ask to share the link to the notebook. The reason that's important is because anyone who joins after doesn't see the chat, but they can see Q&As. So then I can just keep telling them, go look at the Q&A. All right, again, notebook for today's session. I'll copy this. Thank you guys very much. Okay, we have 3. That's probably fine. Type answer, send, 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 and send. Okay, should be good. Let's continue from here. So we're gonna walk through this notebook. I'm actually also curious. I didn't ask this last time I covered it. Does anyone who has experience building a machine learning model in the chat, just say yes or no, and maybe if you want to say like extensive experience or no extensive experience at all. I'm just curious to see what the vibe check is. See some mostly yeses, some no's, yes, no. Maybe 2 yeses for every no, roughly. Nice. Some people with very extensive experience building RNNs and toy GPTs. Great. Okay, so I think there's a mix, which is always going to be the case. This notebook for people who have not built a model will be like your good intro. For people who do have modeling experience, it'll, I think, show you how to frame this problem in a modeling way. And then it'll kind of give you a template to add more features to this model, add more enhancements, really think about how you would try and train a model with optimal performance. But I think there's a bit of something for everybody. You can also feel free to download this notebook so you can run it on your end. The version I have shared is read only, but if you download it or make a copy, then you should be able to walk along no problem. I will say just for time, if you do have questions, put them in the chat and I'll try my best to answer them as we go through. But again, think the hour moves by very fast, so I just want to make sure we're covering a good amount of stuff. So this notebook is a run all notebook. You can literally, once you add one thing, click run all and be able to get the insights from it. The one thing you'll need, and I'll encourage people to do this now because it happened last time, I'm using data from the Federal Reserve, FRED data, which through Python, you need an API key. You probably do not have this. I've removed it from the notebook, but I have it running. I would recommend people go on this website. You have to make an account. It probably takes a few minutes, and then you can get an API key. If you want to follow along and run it yourself, you don't have to. It's fine. I'll walk through everything. But if you're curious, I will post it here as well. Link to get the API key for Fred. Okay. And then hopefully in the first few minutes, some people are able to get their API keys and then can follow along. Again, super optional. I guess before we jump into it, again, overview, we're going to talk about AI techniques, ML techniques for stock market data, generating insights, building models to predict stock price, which you'll see is maybe not as easy and also at the same time easier than you might think, right? Anyone who is interested in data science or even just finance and stocks, maybe you don't have any AI ML experience, this will kind of be a way to jump into it. And again, it's a highly condensed demonstration of what would really be and is a full 12-week course where we go more into these details. One tool we're not going to look at is classical analysis of stocks, building something like a discounted cash flow model. That's not machine learning related. It's just simple kind of addition and subtraction type of math and multiplication, but very, very powerful. Not in this workshop, but would be something I would want to spend more time in. So just to kind of frame what we're going to be covering. Why doesn't it want to zoom in? There we go. Right. So kind of the motive here is forecasting some future stock price based on historical data, right? These things can guide investment decisions. Maybe we can beat the stock market, maybe we can't. That's kind of always the thing. What I like to show and make sure everyone is aware of is at the end of the day, the stock market, the S&P 500, this collection of the top 500 companies in America, excellent thing you can invest in, but they always follow expected earnings. And a stock price in general follows the company's expected earnings, which can vary. That's where the speculation comes in. Like, who makes the expectations of what earnings, again, just think of it as profit. Who makes the expectations of company profits? Well, people who maybe build models like this and other type of models, but they can be wrong, they can be right, they can be wildly inaccurate. But at the end of the day, the stock price follows these expectations. So you're gonna like this plot, I like it because it's basically the stock price and then it's the actual company's earnings. And what you see is that they're lagged by about 1 year. Typically, uh, the market prices in next year's earnings, right? The expectation of earnings for next year. So the stock price will start to go down before the earnings actually show up on these companies' earnings report, because again, they kind of see the writing on the wall. So in general, this is the concept of like, in the short term, the market is a voting machine. What defines the price movement in a given day is very hard to predict and nail down. But in the long run, it's a weighing machine. If you invest in companies that in the long run will increase their earnings, their profits substantially, you will make money and the stock price will go up. And again, we're going to be looking at models that are typically good in the short term, right? Forecasting what a stock might do in a short term. But again, in the long term, we're thinking of the weighing machine. We need a different kind of model that tries to predict and estimate a company's earnings over time. If you look at, for example, NVIDIA, their stock price, if you wanted to predict their stock price going from like $10 to $130, look no further than their income, which at the start of this NVIDIA bull run, if you guys follow the stock, has like more than 10x in the last 2 years. Yeah, their earnings were very, very small in this period, right? A couple of $1 billion. And then ChatGPT comes out, demand for compute goes through the moon, and they go from, let's call it 1 or 2 billion in earnings very quickly to $19 million in earnings. And then the stock price follows that. So how can you try and predict this? I mean, you need to be really keeping up with news and trends in industry and use a lot of those insights to try and forecast this. For anyone who's joined late, by the way, the Q&A answered questions. I'm seeing a Q&A. Fred is free. I'm so mad ChatGPT directed to paid ones. Yeah, don't try not to pay for these things. A lot of them are free. And if you want to turn on your camera, go for it. That's fine by me. Let's make it interactive. Again, for questions, try and ask them in chat. It's going to be hard to do interruptions. But by the way, one of my favorite indicators while we're talking about this, actually, wait, let me go back. Okay, first in the notebook, let's just get an overview of what we're doing. We want to find patterns at the very least. It's useful to understand the patterns happening in the stock market. So what I've done is I'm using things like Yahoo Finance, which if you're using ChatGPT, usually it recommends this, sometimes yes, sometimes no. And I'm going to look at one of my favorite stocks, Tesla, between the period of roughly the last 4 years. Here, paste in your API key once you get it. Mine has already been pasted in, it's in memory. We can run this cell to get stock data from Yahoo Finance. On this date, we can find and let me zoom in a bit here. We can find what the closing price was, what the opening price was, what the high that day was, the low, and the volume. Volume being number of shares traded that day. We have this information for the entire time period. Here, I've provided basically a utility function to get Fred data. Don't worry about what it's doing under the hood, not important right now, but we can just run it. And I said, I want GDP data, I want unemployment rate, CPI, the federal funds rate, treasury, blah, blah, blah. And okay, I have these things here too. We don't need to go look at an ugly table because, I'm merging them, by the way. So I kind of want to share a common timestamp. My data granularity, I've chosen to be at the daily level. That can change for you. You can choose to do these things at the weekly level, at the monthly level, at the second level. Typically, as you get more granular, you probably need to start paying for data because getting second level data is something you probably won't get for free for most providers. But point is, we can now merge all of this into a nice, pretty data frame where for a given day, I know some things about the price and I know some things about the macroeconomy. Forget about these plots. Let's just go and visualize these things. This is where having everything in a notebook is nice. We can just plot out what the price of Tesla was, the closing price, the blue line, on a given day throughout this time period. And then I'm also plotting out volume. Typically, what you'll see is high volume corresponds to high price movement. So when the price was going down a lot around end of 2022, beginning of 2023, we see a lot of volume. And clearly, because the price is going down, more selling than buying. On the flip side here, around actually just 6 months ago, like July-ish 2024, we see a lot of volume in the positive direction. And then also a lot of volume here, which I think corresponds to the election. If you guys have followed this stock since the election, this and a lot of other stocks have gotten a pretty big jump. You kind of see that represented here. Last thing I'll just flash before we keep going. Let's look at our macroeconomic data. So we can see GDP. And if you notice, in my function, I'm actually filling the data forward. GDP doesn't change, or we record GDP every quarter, let's say. So for 3 straight months, the GDP value is the same, which is why you see this stepwise type of function. But okay, we're seeing GDP of the US. We have that information. We have more granular. This looks like monthly. Typically, we get unemployment data monthly. We see the unemployment rate over time. Large, it was pretty high because of COVID in 2021 and then went pretty low. We can also see CPI. And actually, CPI, if you take the derivative of this, if you take the rate of CPI, that's the inflation rate. CPI itself is just a raw number for the cost of a basket of goods. The rate of change of that year over year is your inflation rate. If you've been keeping up with this, you know that it's been pretty high the last few years. And now it's starting to taper down a bit. It's around 3%. but it was a huge problem uh, from 2021 to even 2023 was something that directly influences this. So if you know economics, you know that, unemployment rate, inflation, and the federal funds rate are intertwined. Just to give some context of this, because I find it super fascinating. And by the way, the federal funds rate has basically been the thing driving the market for the last few years. People are really just trying to figure out what the Fed is going to do. Long story short, when you invest, you want a low federal funds rate. This is like a low interest rate. How cheap is it to borrow money, right? You pay interest on a loan. That's what the federal funds rate. It's interest on borrowing money. When it's cheap to borrow money, that fuels growth because, oh, I can just borrow money for like low interest cost. I can use that to fuel my business, invest in my business, blah, blah, blah. And that typically increases economic activity. The flip side there is if it's too low for too long, you can kind of get runaway inflation because people just keep spending and then there's more dollars chasing the same amount of goods. So there's a balance here. What happened is CPI inflation was very, very high. We were seeing that in 2021 and 2022. So the Federal Reserve, the US central bank, skyrockets the interest rates from basically 0% to 5%, which really increases the cost of borrowing, which hurts a lot of companies' growth. So typically stock prices go down. And the flip side is it helps cool inflation. So a little bit of a macroeconomic lesson here. Again, we'd go into more details on why this is interesting. In discounted cash flow analysis, by the way, which is another way to value companies, you really are sensitive to the federal funds rate. Because if you think about it, the current one way to think of a company is the value of all its profits in the future discounted to today. Part of how you discount that, like how much is $10 in 5 years worth, is related to the cost or the federal funds rate, which is like the money you would get from just borrowing or lending. So these things are super related. Again, we'll go into more detail later. We're kind of already at 12:30, so I don't want to spend too much more time on it, but it is super fascinating. And just taking a quick peek at some questions. Looks good. Okay, awesome. Hopefully that's clear. Okay, so we did a whole bunch of EDA, right? Like if you are familiar with data science, this is kind of our EDA. Let's visualize our features. Let's get our data set together and figure out what's going on. You need to have an understanding of your data in order to do correct modeling. Next thing you can do is feature engineering, which is, okay, you have some collection of raw data. Maybe you can combine these and create new signal. One thing you might do is calculate your RSI, which includes like its relative strength index. Basically just tells you, is the price, how can I frame it? The strength of the price movement, right? Is it being bought up a lot and the price has been going up over some period of time or been going down over some period of time? Here's a function to compute this. We can calculate RSI and add that as a feature in our data set, which we're showing here. So we have the raw data, and we also have some extra features we've computed, which is RSI. 1 day lag, right? Other things you might use is, hey, let's use yesterday's information to help predict tomorrow's information. And then moving averages, which is like a stable, just literally what was the sliding window, the last 50 days, the last 200 days. Take the average. That's our end day moving average, used frequently in stock price evaluation. Cool. So we have a nice data set with all of this information. More information you might want is like, how do we factor in the time component into our prediction? These data points are not independent of each other. Clearly, we are going to be trying to predict the future based on historical data, and they're sequential. One way, and there's many ways to do this, is to just naively strip out the year, month, day, even weekday, and add that as a feature in our data set, which is what I'm doing here. And again, we see that reflected when I display it in the notebook, what the year was, what is the month, from 1 to 12, what is the day, and what is the weekday. Because, for example, you might find that there's a trend where the stock trades a certain way on Mondays that's different than Fridays. And maybe you can dig into why that's the case, but you would be able to pick up that information if you have it as a feature in your model. Okay, so hopefully that's clear so far. I'm also curious, was anyone able to get their Fred API key and run along with this? Um, Go for it if you have a comment or a question in the chat. Okay, have an API key, have an API key. That's awesome. Oh, I missed where to get the API key from. Let me paste it in the chat again. Fred, get API key. You'll need to make an account at the Federal Reserve and then just go through the steps. Hopefully it's not too much work after that. I'm seeing someone ask the link for the LLM session. Let's circle back on that one at the end of this session, just to make sure we cover everything. Okay, so we spent some time getting our data together, which in my opinion is the most important part. What I'm going to show next in the notebook is a bunch of different forecasting approaches. How do we take this data into a prediction about the stock price? But honestly, what you're going to see is that no algorithm is magically going to be able to predict the future. It's completely dependent on your data quality. And, we'll see some interesting results in the rest of this notebook. One thing you might think of is this information really enough? Is this enough to accurately predict a stock price? What does it even mean to accurately predict a stock price? And these are some questions you might ask. And by the way, because I do in my job review like resumes, do interviews, and I know a lot of people are doing these side projects, which is great. Like you want to build out your portfolio, but make sure you go deep. Like doing a single time forecast, like one of the things I'm about to show, is not deep enough because there are so many reasons. There's so many layers you can peel back of this onion of why you're forecasting. Why did you do this? What did you do when you got this result? Just general advice as you're building up your portfolio, and me as an interviewer and someone who reviews, I'd rather a small collection of projects that you went deep in and had real motivation for pursuing than a large amount of projects that were more shallow. So I'd say focus on depth. And that way you can really carry on a conversation of like why you did certain approaches. And let me just check here. Where do I get the notebook? Link to the notebook is in the answered Q&A section, by the way. So if you go to the Q&A section and you go to answered, I have pasted in the link to the notebook. I'm seeing someone, you may not have, your API key seems to be failing. Hard for me to debug now. I'll key error date. Throw that one into ChatGPT and see what it says. Again, I'll try and circle back. But let's focus back on the workshop. So here's our data set. Here's what I'm going to do. My goal for forecasting, which you can call your target or your Y variable, is tomorrow's close price. So I want to use all my information available on a given day, one row here, to predict what the close price tomorrow is going to be. I'm simply constructing that here. I'm taking the close price, which I have, and shifting it one day forward. And I'm saying that's the column that I'm trying to predict. Okay, some other data massaging here. I'm basically just splitting things into X and Y. Okay, so my X variables was what I'm going to use for prediction, and Y is the target I'm eventually trying to predict. Another thing, if you're familiar with machine learning, is this concept of splitting your data into train, validation, and test. There are more sophisticated ways to do this than I'm demonstrating. I'm just doing the simple, naive approach, which is ordering things on time. I'm going to take the first 80% of the rows as my training data and the last 20% as my test data. If you're familiar with machine learning, you know why we do this. But if you're not, you might ask, why do we split the data this way? Why don't we just use the same training data to test the model? And it's because think of it as memorization, right? Like these models can eventually get to the point where it's called they overfit on the data. They're essentially memorizing it. But what you really want to know is how well does the model generalize on data it has not seen before. So you want to have a data set that the model has not seen before, has not trained on. That gives you a more accurate indication of how your model will perform in the real world, since typically you'll get overestimated positive results on stuff your model has seen and trained on. You can think about it as like, let's say in school on a test. If I just give you a practice test and say, I'm going to score you on how well you do on this practice test, you could probably just memorize the whole thing with enough time and then come the next day and write everything you memorized and get 100%. But that's probably not a good indication of what you really learned. What I really want to do is give you some practice tests, have you learn them, and then give you a different test that is similar, but not the exact same questions, but of similar concepts, and see how well you do on that test. That's probably a better generalization of what you have learned. And we do the same thing in machine learning. And just to kind of illustrate this is what I'm talking about. This is my target, the close price tomorrow. I'm taking all data in the green to be my training set. Here's what I'll use to train the model. And then the yellowish is the test portion. This is going to be tomorrow's price. Again, this is one way of splitting. It's naive, but we don't need to get into the details right now. And then again, here's where we're splitting it. So good practice for every time you will ever pull out a machine learning model from sklearn or Hugging Face. Before you do anything complicated, you definitely need a baseline. And I'll also say in general, like anytime you explain your machine learning approach as you're doing anything machine learning related in work, in school, establish a simple baseline. It'll save you a lot of headache. The reason is, what is like the no work performance I can get on this data set? One way to think about that, this is helpful for establishing a benchmark, blah, blah, blah. Let's say this. One naive benchmark is just like the rolling average. So what I'll do to predict close price tomorrow is simply take the average close price over the last 50 days. That's what this green line is demonstrating. And then again, the blue is the actual value. So you see, they're not very close. I can tell you right now, like they're not very close. There's plenty of error in this model. Another thing you might want to consider is how do we even define performance? Again, important to understand this well in your ML approach. And there's different options. There's not one only correct way to think about it. This is what's called a regression task, and there's multiple ways to score this. You can think of it like visually, I think we can all see some idea of how far is the green line from the blue line on the same day. That's kind of what we're trying to gauge. You could just take the absolute value sum it up over your whole data set and then take the average. Uh, if you take the absolute value of that, that's called mean absolute error. You could also square the difference and then take the square root. That would be root mean squared error, RMSE. But in stocks, in this case, we actually don't care about the absolute value. We don't care if you're like off by $5 or $10 because what does that mean? If the stock itself is a $5 stock and you're off by $5, you're off by a lot. But if it's $1,000 stock and you're off by $5, then that's a lot more precise. That's only 0.5%. So we typically care about the mean absolute percent error. Like what is your percentage error relative to the correct value? And we call that MAPE. So here, just kind of showing the raw guts of how MAPE is actually calculated, just for instructional purposes. You can just import this function from popular libraries like sklearn, but that's fine. Let's just define it ourselves for fun. And let's continue with that. Okay, we have MAPE. We're basically going to compute the MAPE for our test set, which we're doing here. And I'm just printing out, hey, MAPE using this 50-day moving average of our baseline is 11.37%. So on average, I'm wrong in either direction by 11.37%. That's probably not very good. If your stock price prediction for tomorrow varies by 11%, that's pretty wild variation. Let me just quickly check. Oh, I'm seeing some good questions. Why split train and test data based on timeline? Why not random? This is also a great interview question, and it's fundamental for your understanding. There's kind of two concepts at play here. One is a little bit more nuanced, which is this idea of data leakage. Forget the data leakage. Why do we care about making sure we only predict on the future? I think just intuitively, when we deployed this model, it's always a future prediction. We're always predicting tomorrow or next week's or next month. We never care about predicting last week's price or yesterday's price because it's already known. So similarly, we want to make sure we split the training data such that it's always predicting forward-looking, not backward-looking. Similarly, there's this concept of like, another way to think about this is interpolation versus extrapolation. Let's say for whatever reason, I split my data and I ended up such that, from 0 to 200 is training and also 400 to 600 is also training. And somehow 200 to 400, this section became test. What that means is actually it's typically much harder to extrapolate than to interpolate. So if I know, let's say 0 to 200, and I know 400 to 600, it's actually easier for me to kind of fill in the blank than to just go fully forward. Because this information from points 400 to 600 has, intuitively speaking, anchored my prediction. And I only have to fill in the information in between it, which, think about it this way, if the stock price didn't move much from 400 to 600 and it didn't move much from 0 to 200, what is the probability that it moved a ton in this missing range? Probably not very likely, right? So just high level, interpolation is always easier, less error than extrapolation, going out into the future. Another approach is there's also something to think of called data leakage. Some of your labels, some of your data may actually be using previous information or maybe calculated based on information. Basically, what can happen, and this is super common in machine learning, is your features actually contain some information about the future if you don't compute them correctly or if you don't split things correctly. And that'll cause you to overestimate. That'll cause your predictions to be more accurate when you frame it this way, when you set up your experiment. But it's because of data leakage. So you're actually overestimating the performance of the model. And what'll happen is when you actually deploy your model, since you no longer have the benefit of pulling future information, it actually performs worse than you previously estimated. So a bit of a long-winded thing there. But in general, we always want to make forward predictions for those reasons. And actually splitting it this way is not even the most sophisticated way. I'll just flash some concepts like this idea of a forward march or a sliding window is also commonly used. And you could think of it as just always, start with, let's say, a window of 0 to 200 days. And we train on that, and you simply predict the day 201. Cool. Now let's train from, this is called an expanding window, from day 0 to 201 and predict day 202. Capture that error. Now again, train a whole new model from 0 to 202 and predict 203. So you can tell that's probably computationally intensive, which is why you might not do it that way, but it is an option. So hopefully, again, for some of you, that may be something you already are familiar with. For some of you, I just said a whole bunch of jargon that makes no sense. It's okay. Again, I think both groups can kind of get something from this. The whole point is, there's a reason we do this. I'm demonstrating it now, and we'll kind of walk through. By the way, this is probably the most interesting or the funniest part in the context of the next part of the notebook. Another baseline, and this should be your baseline, I think better than a 50-day moving average, which doesn't work very well, as you can tell, for volatile stocks like Tesla. Tesla is a volatile stock. It moves a lot, as you can tell. If this stock were instead something like Coca-Cola, which is a super mature company and does not have much volatility, maybe the 50-day moving average would be better. But another baseline you should probably think of is simply predicting that tomorrow's price will be the same as today's price. That's a very naive baseline, but how well does that work? If I simply predict, hey, tomorrow's price, my target is the same as today, what is my error? You can actually see it's only 3.05%. It's not that high. So on any given day, basically what this is saying is in my test set, on average, the stock moves 3.05% from one day to the next. Pause there and think about what that means. We know this simple approach gives us a mean absolute percent error of 3.05%. Therefore, any fancy model we need or we're about to create should probably beat this. Else, why are we using it in the first place? Why it's not even useful if it's not beating this number. That's exactly why we create these baselines. So we have some sanity check on this black box model prediction. Hopefully that's clear. So with this sanity check baseline in mind, I'll kind of flash two ways to think about training a model. It's not the only two ways. These are very naive, but fire hose approach, trying to cover as much as I can in a small amount of time. One approach is treating this like a regression. So regression models, they use the features we have, the data we have to predict the stock price tomorrow. We could explore linear regression as one example. Linear regression is, as you might expect, just making a linear relation from the features we have to try and predict tomorrow's price. You can also use this model or this algorithm called a random forest, and in this case, a random forest regressor. We won't go into what this is doing under the hood. I encourage you, if you're not familiar with it, to read up on it. There's a bit of documentation flashing on the screen. But let's use this random forest regressor to predict tomorrow's stock price. you really only need like four lines of code, which again, if you're not familiar to modeling, might blow your mind. But the most naive, simple approach really just takes 4 lines of code to initialize your model, fit it, aka train it on your test data and what the target should be. And then here we're just actually that's it. The model's trained. Now we're just seeing how well did the model do on the training set and how well did the model do on the test set. Simple as that. And we're just plotting it. So let's just go and look at this. You're seeing blue line kind of shadowing here is the training truth data, like the actual closing price that we're trying to predict. And green is the prediction. And you can see they're pretty overlapped. There's only a MAPE of 1.08%. Again, if you're not familiar with modeling, you might say, hey, that's pretty good. Job done. Let's go ship it and make $1 billion. But unfortunately, that's why we have the test set, because again, models tend to overfit on the training data and do worse on data it has not seen before. That's what the test data is for. And we see that it actually follows the price worse. It has a MAPE of 3.75%. And you might also look and say, hey, wait, why is it actually doing pretty well up until these last few days where it like completely misses these latest spikes? The answer is, I don't know. We'd have to dig into the model and figure out what relation has it established between our features. That's really like the core skill set of a machine learning engineer, machine learning scientist, is not to be able to run these 4 lines of code, but to be able to put in high quality training information. That's a huge chunk of what we care about. How quality is your data? And to be able to investigate your model's results and then iterate. Okay, we have some benchmark performance. Can I change the data? Can I change the parameters of the model? Can I change the whole framework that I'm thinking of to get better results? That's where, the value of machine learning really comes into play. Someone brought up a very good point. I am not using a validation data set to generalize your model. Correct. I am, and again, if you're more familiar with machine learning, this is not like a robust approach. I've just used it for simplicity. Typically, you want 3 data sets because typically what you'll want to do is you have multiple models you want to test. Model A, B, C, D, E, F, G. And you will train this model on some data, and then you will use another data set to figure out how the model is doing. But then you need, if you have multiple models, you need to select one that is kind of like your final pick, right? So if I just train all the models on the training data set, and let's say I have 100 models I've tried, which is completely normal in machine learning, and then I evaluate them on the test set, and then I just pick the model that has the best test set, that's a big no-no, because I'm realistically, just by luck, if I try 100 different models, some of them will do very, very well. I'm actually incorporating selection bias into my process. So if I'm going to say, oh, the best model on the test set got 0.99% MAPE out of these 100 models, therefore I can be confident that in reality, this model will get 0.99%. That's a no-no because you're basically biasing your results based on selection. What you actually need to do is create a third data set, which is your validation data set, which you use for model selection. So the kind of framework would be train a bunch of models, evaluate their out of sample performance on the validation data set. Okay, so then you get an idea of how all these models perform outside of training. That's called your validation performance. Then, okay, you might pick your top model or 2 models, and then and only then do you evaluate it on the test data set that it has never ever seen before. And then that's the performance you would report. You can't use your test set for selection, since then now it's going to you're basically going to be biasing towards a model that performs for luck really particularly good on the test set. So again, we can go into that concept more. It might seem confusing, just giving you the framework here, and we go into more detail with more time. We have a few more, or we have like 5, 10 more minutes. Another thing you can do is kind of like I talked about, just to go back into the core workshop here. You can figure out what features are actually driving this model's predictions. And what we're basically seeing is the model is using a lot of um, today's close price. This is what this feature was, today's close price, to make tomorrow's close price prediction, which makes sense. I mean, we know that, today's price is probably going to be pretty similar to tomorrow's price. And then it's also using the low, the high, the open, and then a little bit of these other variables. But we're seeing they're not that important, of like RSI, the moving average, and basically no importance at all based on this model on the macroeconomic data we created. You'll probably see that on single day predictions because macroeconomic data like moves stocks in months and quarters and years. On a day by day level, unless a new CPI, like a new piece of information just came out on the same day, it won't change since these things only change once every month or 3 months. Hopefully that's intuitive. Okay, so that's a bit of a fire hose on the regression approach. Just gonna quickly take a peek here. I see a question. It's like regarding models, where do externalities fit into predictions, such as, for example, a sudden major work stoppage by Tesla manufacturing employees? Let's say all of Tesla's employees go on strike one day. You'd probably think that makes the stock price go down, which is reasonable. But you need to somehow include that as numerical information to your model. So you need to have some column that basically conveys this information, which that example is like a specific example of news event and sentiment. Like, let's say something happened let's say Elon Musk like retired from Tesla. That would probably bring the stock price down too. So if you had that feature available in your model, you could probably help predict what the stock price would do that day. But at the same time, after that information is already out and in your data set, it's too late. Like, it's already happened. It's not something you can use as a future prediction. So what you might want to do is have features that are actually predictions themselves. You might have a feature, like let's say you've constructed a model to predict the probability that Elon Musk is going to retire. Then you can put that in your model. And, if you're actually correct, your model would do a good job of predicting the stock price tomorrow, presumably. So it gets a bit more complicated there, but a lot of forecasting involves these sentiment-driven things. And it's definitely possible, and you should get more data than this. This is a very naive, simple data set, just for kind of like educational purposes. If it were so easy to predict the stock price with just this data, I think we'd all just be like mega gazillionaires. Unfortunately, it doesn't work that way, but it's good to think of the fundamentals and build from there. Okay. Last thing I'm going to fire hose is a different, more popular or reasonably popular forecasting approach. If you've heard of Facebook profit or profit forecasting, it's a way to decompose a time series trend into kind of like a linear combination of your different features. It can break things down into like, let's say, an underlying trend, seasonality based on day, week, month, and year, and other exogenous features you have. I don't have time to go into the details, but I am providing the setup for setting up this type of model, which you can just import from Profit. Getting it all set up, and then doing the same thing. Train, test, split. And then we simply fit the model. Down we go. Again, just some data munging to make sure our columns and data line up and everything. And what I'll just show here, skipping over all these tables and whatnot, is eventually you can make predictions on your data. And, there's some nice utilities to plot this. So again, we've split it such that training is up until roughly April-ish, 2024. This is an interactive plot, which is pretty cool. So you see, this is the training data. We're actually reporting the training MAPE for this model and the test MAPE for this model. You can see it's like actually doing a better job than the random forest of actually following the trend. So if I go back to all right, won't dig too much into it here, but let's just go down somewhere down here. I have a plot. There we go. Okay, this is the plot visualized in kind of the format I've been using before. Unlike the random forest, it actually is able to, at least when a spike happens, predict the spike. But if I had to guess, it's probably typically off by a day or so. This is what our metrics are showing as well. Like, think about it. This MAPE we reported here on the test set, this is still not as good as simply taking yesterday's price and using that to predict tomorrow's price. Now, the thing is, in reality, you might just not need a simple, like this model is obviously more sophisticated than using simply yesterday's price, which you might be off off high, you might be off low. The nice thing with these models and that you'll see is they actually give you a bit of a range too on the prediction. So this shaded region. Maybe you don't need to know the exact stock price, but you just want a range of confidence of where it's going to be, and somehow you'll use that information in your decisions. If I go down here, let me just scroll down. Yeah, this forecast data frame is what Profit produces. It actually tells you for the given day how it's decomposed the trend. This is the lower bound prediction. This is the upper bound prediction of the stock price. Y hat lower, Y hat upper. We see that for all the data points. So you can see like it's kind of, it has error built into it. It has a confidence built into it, which is more useful than a single point prediction. And then it's also telling you how each of these features we have, like CPI, is driving the prediction, whether up or down. It's a linear combination of these things. So the yearly component, how much is that impacting its prediction? The 10-year treasury rate, how much is that impacting the prediction? And there's more columns here that are just being truncated. We don't need to go into the details right now, but we have all this information available. We can also plot some of these decompositions. So this is just the overall trend it's picked up. You can visualize and see what the weekly decomposition, like what the weekly trend has been. So, Sunday and Saturday, just forget about those for now. But it seems like Wednesdays are a particularly bad day for Tesla. Like Wednesdays drive the stock price down more than any other day. Maybe you can use that information. Yearly is a little bit more noisy because again, we only have a few years of data, but it seems like for a given month, let's say for whatever reason, March and September tend to be, larger drivers to the stock price than other times in the year. And then this is showing you what your extra regressors. So outside of just using the price itself to predict the price, kind of like auto-regressive, what are your additional features, CPI, GDP, blah, 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 blah. How are they contributing to the forecast? And that's kind of being decomposed here. Lastly, just to flash it again, not too much ability to go into the details, but you can see how each one of your exogenous features, oops, is contributing to the forecast. So we're seeing that the close price, basically today's price to predict tomorrow, is like far and away one of the biggest contributors. A lot of the time and actually it's funny, in periods of high volatility, we're using that more than other features uh, to make the prediction. Contribution of the open price, right? How is that being decomposed? Of the high price, the low price. Let's go to more interesting things. Volume. How is the volume being used to make the prediction? And GDP, and so on and so on. So we have a lot of features. We don't need to go through all of them, but we can decompose these things and again, look into this, draw some conclusions, try and represent those conclusions in our data set, in our model, and then train the model again and see if we're able to get better performance. So hopefully that wasn't too much of a fire hose. I know we covered a lot in a short amount of time. We're basically at 60 minutes right now, so hopefully that was interesting. Hopefully some of you were able to run along with the notebook. If you've modeled before, maybe you have some ideas of how to improve this. There are many, many ways. I haven't done anything like HPO or a more sophisticated train validation and test strategy. Those are things you might want to try. And if you're more new, try and tinker around here. Like, what if you drop a column? What if you just slightly modify things? How does it change what's happening in this notebook? That might help build some intuition. So that's yeah, that's the workshop. That's data to dollars, figuring out how does this whole concept of uh forecasting and predicting stock price work. And hopefully that was helpful and interesting. I'll stop the share now. I'll stay around for a few more minutes for questions. Otherwise, yeah, hope you enjoyed. Palantir is not Tesla. That's funny. Those are two stocks I definitely follow a lot. Very popular with like retail investors, for better or worse. What about IBM Granite time sequence models? Not familiar with what that is. Uh, I'd be curious to just play around with it. Uh, Typically, like the concepts. One thing we didn't cover is like using neural networks, specifically something like an RNN and sequence-based models, which you could even, if you guys know about the technology behind LLMs, it's transformers. Transformers are very good for sequential data because if you think about it, text is sequential. So that means, wait, maybe we can use this for forecasting because forecasts are also sequence-based data. That's an approach we can look at with more time. There's definitely a lot of work being done in the industry on that. Did you have a look at quantum stocks? I have not. Uh, Again, those ones, it's like who knows what the earnings are going to be in 5 years, which again is roughly what the stock is following. The variance and the spread of that confidence interval is huge, and I don't know the field enough to have any confidence on how these stocks might actually perform. But it's interesting. I mean, quantum computing will definitely be part of our lives at some point. I just don't know when. Is it possible to do technical analysis charts and train neural network on them? Absolutely. Yeah, if TA is a lot of what people use for these short-term predictions. I don't know much TA myself personally. I just know a very cursory level. But you could probably, yeah, you could train a model as long as you represent the data correctly to make predictions based on what your TA is saying. Cool. How can we bring in features outside a data set like tweets, public sentiment? Yeah, so this is where, you have your data pipeline. You might need to do some feature engineering. Some way, somehow, you need to, if we're working on the daily level, represent sentiment as a number for a given day. Maybe you have an NLP model to do this. That's like the common Twitter sentiment example. It's like the most beaten to death ML example where you take Twitter information and then you compute sentiment on tweets and maybe you do something with that sentiment. That's really the bread and butter of machine learning as a profession. How do you take information in the world that is inherently not numerical, like sentiment, and intelligently encapsulate that information and then use that information to make inferences about the future? That's like the whole field in a nutshell, in my opinion, at least. And then obviously you can have smarter algorithms. That's true. I should say that smarter algorithms, like for example, transformers, can also get you better results. But those two things are at play: data, algorithms. Cool. Okay. Awesome. Thanks, everybody. Hopefully it was helpful. Feel free to play around with the notebook and maybe see you in another workshop or another class. Bye bye.